Hello, welcome to video 2 for module 4. Let's get started. So remember back to week 1, we were trying to think about what kind of things that we could invest in. So there are lots and lots of different things we can invest in, from just simply investing our cash in a term deposit, or perhaps we could buy shares or some property. It could be rural property, it could be empty land, or it could be a house or apartment, or perhaps it could be commercial property. We talked about gold and investing in commodities, wheat, and there's also the more unusual investments of the alternative assets, such as artwork, Bitcoin, and then we get into financial derivatives, or perhaps we could invest in tolls and infrastructure. We break these up into our 5 different asset classes: cash, fixed interest, that's another word for bonds, remember, property, equity, and then our alternative assets. So when we're investing, we often think about investing in Australia with Australian property or Australian shares, or buying alternative assets here in Australia. But we need to remember that we're actually only quite a small part of the world. So we make up 2% of the global economy. And I was just checking the statistics. We were 14th when it came to gross domestic product in 2019, and in 2021, 12th in the world. But we are actually a tiny percentage when we talk about the whole world, less than 2% in fact. So that means that there is a great deal of opportunity out there in the rest of the world, 98% opportunity. So what does that mean for investing? Well, we need to think about what's going on overseas and where we can invest to help us with our diversification. It gives us a great chance to be able to diversify our portfolios. And if we are diversifying, then that's going to help with reducing our risk by reducing down the variability of returns. We can also get better returns overseas than what we may be able to get by just purchasing in Australian for the same amount of risk. How do we access these international assets? Well, you could do it directly, purchasing them yourself in your own name, but this can have problems with tax, be not very convenient or expensive and riskier. You could invest in multinational companies, or you could invest indirectly through investment in country, global, and other international managed funds. When we're thinking about risk, we break it up into 2 different categories: diversifiable and non-diversifiable risk. So it's important to understand the difference between these two when you're considering your portfolio. Remember, we're trying to make one efficient. So we've got diversifiable, which is also called unsystematic risk. So this is specifically related to that investment. So things that will happen in a specific firm, some kind of uncontrollable or random event that happens. So we can eliminate this through diversification. For example, perhaps that business has a strike, or perhaps that specific business is being sued by a customer. They may have slipped over on the floor, so they've sued them for their injuries. So that's our diversifiable risk. Then we have non-diversifiable risk, also called systematic. So these are forces that or events that are impacting all similar types of investments. We can't eliminate it through diversifying. So perhaps that would be a war, inflation, political events, I think we can safely put COVID into this category. So we've got our graph over here. How many securities do we have? And what's our portfolio of risk? So if we only have one, so we have only invested in one business, so we're over here on the far left. Now, if you have a look, our diversifiable risk, we're right at the very top in our risk level. As we purchased more securities in different businesses, the diversifiable risk is reducing. We're not just relying on one business. So diversifiable is the risks that happen to specific businesses. So now if I move across to here, I've got 5 different types of shares. I've got less risk with one of them perhaps being sued or having a strike in their business because I've got 4 others. As I move along further with purchasing more and more different shares and different businesses, my diversifiable risk is being reduced down. Now I still have this level of risk. So it's made up partly of my diversifiable risk, but mostly it's made up of the non-diversifiable risk. And the more shares I own in different businesses, that will not remove all the risk. It's only reducing down the diversifiable risk. We use beta to measure that non-diversifiable risk. So it indicates how the price of the security responds to the market forces. The more responsive the price is to changes in the market, the higher the beta. And the beta is found by looking at the historical returns for security compared to the market returns. So remember, the market has a beta of 1. So shares can either have a positive or a negative beta. So if the share has a beta of greater than 1, that means they're more responsive to what's happening, to changes made in the market. And so they're riskier than the market overall. So they're more volatile. If they've got a beta, if a share has a beta less than 1, then it's less responsive to changes in the market return. So it's less risky than the market. It's less volatile. So the higher the share's beta, the greater its expected return should be. So most betas are between 0.5 and 1.75. Now all the betas are going to be positive. For shares, they're all in the same market of the share, and mostly they are positive. As the share market goes up, then their value will increase. Here's an example of some shares and what beta they have. So you can see BHP, slightly higher, remember the market beta is 1. So BHP slightly higher, Commonwealth Bank slightly, but you can see that that's pretty close to 1 really, isn't it? 0.98. It's almost representing the market. Remember the Commonwealth Bank was actually number 1 when we looked at our list of shares on the Australian Stock Exchange. I think that's InfoCare, 1.26, so more volatile than the market. And if we look over here, Woolworths, 0.73, so less volatile than the market. How do you find out what these betas are? Well, you can find them out using great power of the internet. So here what I've done is I've had a look at CommSec. I do have an account with CommSec, so I may have been able to see this while others may not. I'm not quite sure. So I logged on, looked up Wesfarmers, and then it gave me all this information about Wesfarmers, and part of that is it says the 5-year beta, which I've highlighted here, and you can see 0.87. So this one slightly less volatile than the market. The information is available out there. We're very lucky now what information we can find out fairly easily with the internet. So another formula, yes, not escaping them. So we've got the capital asset pricing model. So this is bringing together the concepts of risk and return, and it's using beta. It uses beta, the risk-free rate of return, and the market return to help figure out what is the required rate of return for a particular investment. So developed in the 1960s, trying to explain the behaviour of security prices. It's got two main parts, the risk-free rate of return and the risk premium. Let's go and see it in action. Okay, so here's our formula, CAPM. So this is the required return for J. Then we've got the risk-free rate of return, the beta for investment J. And we multiply that by first, what is the expected market return, take off the risk-free rate of return, figure out what that number is first, then multiply it by the beta for investment J. This part here is the risk premium for this investment J that's being added to the risk-free rate of return. So this bit is the risk premium. We've got the risk-free rate plus the risk premium. Let's practice this one. Okay, so here's an example. What is the required rate of return for high-flying investments? It has a beta coefficient of 0.85, so less than the market, less volatile than the market. The Australian Stock Exchange Index has an average return of 6%, and the 10-year Treasury bonds are currently yielding 3%. Okay, 10-year Treasury bonds. What's that telling you here? So the government bonds, that's our risk-free rate. So we've got our risk-free rate here, 3%, so that goes into this bit, 3%. The beta for our high-flying investments is 0.85. The return on the market, we're told, is 6%, and we know the risk-free rate is 3%. So if we put all that in the formula, we come to the answer of 5.5% is the required return to invest in high-flying shares. This graph is a picture, so it's describing the formula that we just looked at, CAPM. So let's have a look at it. We've got beta going across the bottom, and we've got the risk return. Remember, so beta 1 is the market. So if we have a look here at, if you had a beta of 1, then the required rate of return would be 10%. If our beta is 0, then the required rate of return is going to be the risk-free rate of 6%. So our line is only starting here at 6%. You can see the green line here, security market line. So that's our minimum risk-free rate, 6%. As we go to a beta of 1, we'd expect 10%. If we went to a beta of 1.25, then we'd expect a return of 11%. Okay, well, we'll practice that some more in class.